I want to talk about fixed income today, and we're just going to dive into that component of the portfolio construction. So what is fixed income? Well, it's a jargony term that we use in financial advising and in markets to represent bonds or something of a fixed nature. So let's talk about bonds. A lot of folks, when I talk to people, kind of in my social life, people are interested in stocks, etc. But by and large, I would say that the average person doesn't know a whole lot about bonds. So a bond is basically just a debt. You're lending your money to an entity, and what they'll do in return is pay you a rate of interest. It could be fixed, it could be variable, but that is set for a certain amount of time. Maybe it's for a year, maybe it's for 10 years, maybe it's for 30 years. Bonds have even been issued for 50 or 100 years. But I would say the typical bonds that you're talking about would be bonds that are issued by governments like our U.S. Treasury, by your municipalities, maybe your sewer district or your local schools or a turnpike. And then, of course, corporate bonds, so Coca-Cola or Pepsi or whoever. They issue debt to fund projects and go into the marketplace and get funding for it in that way. So when you buy a bond, you basically have, there's more than just two, but the primary two risks with bonds are credit risk and interest rate risk. So credit risk is basically similar to an individual. A bond or a company or an entity will have some type of a credit rating. S&P and Moody's are typically the ones that provide these ratings, and they can rank from AAA at the highest all the way down the scale to single A, triple B, double B, etc. All the way down the scale and getting into junk, which is basically below triple B. Junk would be non-investment grade bonds. So the further you go down the scale, all things remaining equal, the more risk you're taking, the higher potential there is for a default on the interest or a default in general, that the company may just, or the entity just goes bankrupt. So that's credit risk. The other major risk is interest rate risk. For example, if you buy a bond last year, you did, and it paid 3%, and we come forward a year and interest rates are now 5%, well, the market's going to pay a lot less for that bond because your bond is paying an inferior rate. The flip side of that is if you buy a bond last year, if you bought a bond last year at 5% and interest rates go down to 3%, well, the marketplace is going to pay you more money for that bond. So it's kind of like a seesaw. Interest rates go down, bond prices go up, and vice versa. Interest rates go up, bond prices go down. So that's interest rate risk. So these things have got to be managed in a portfolio, and we can get into that in another video. But putting bonds into a portfolio, having that fixed income portion is oftentimes something essential. We'll get into other things that we use as fixed income alternatives, but for the most part, that's a good summary of what a bond is and what the risks involved in it. Thanks for watching, and please like and subscribe.